Okay, so you made it through week 2, and these are just some of the key takeaways I'd like you to have from our week's work. First and foremost, I want you to appreciate the difference between the accrual basis and the cash basis for recognizing revenues and expenses. If you think about it, this really all comes about because of the need by investors and users of financial statements to know how well the firm did for a specific point in time, say 2015. And the problem is our business was going on before 2015, it's going to continue beyond 2015. Not everything stops and starts within that calendar year. So this is going to require all kinds of judgments and estimates on the part of management to figure out exactly how to define the revenues and expenses that should be allocated to just 2015. And because we do so much business on credit, we extend our customers credit, our suppliers extend us credit, that it turns out that the actual transfer of cash isn't really the key indicator of the underlying activity. And so we create criteria that are a little more qualitative, like when is the earnings process is complete, and when have the expenses been used to generate revenues. So make sure you're clear on the difference between accrual basis and cash basis. So yes, there's a lot of judgment and estimates required to create a set of financial statements. Everything from, is the earnings process complete, to what are the useful lives of my assets, or are all my customers going to pay me? How many warranty claims am I going to get? There are all sorts of judgments and estimates that are required to produce these financial statements, and you must always be on the lookout for them. Which means, as an analyst or an investor, or really any user of financial statements, you've got to read these things with a very careful and critical eye. You must always be on the lookout for where are the key judgments being made, or what were the key estimates that management made in coming up with the revenues and expenses that determine profits. And do those judgments and estimates look reasonable, or could they have been made with maybe a bias toward making the company look better than they really are? That's always the challenge in reading financial statements. And one of the key tools that we use to help us do that sort of evaluation is ratio analysis. And that's going to be our topic for week 3.